Folks, have you ever wondered what it takes to be called an accredited investor? We're going to find out. And then more importantly, we're going to find out what is going on with the risk appetite of accredited investors, because I'm guessing something has changed. We're going to talk about the one and only Justin from Kearns Capital. How you doing, Justin?
Doing great.
Awesome, man. Well, do me a favor, give us the definition of an accredited investor. Let's dig into that a little bit, and then let's talk about what may or may not have changed over the last year or so.
Yeah, the two main ways the SEC will consider you accredited is either by income or net worth. So on the income side, if you're filing your taxes single, you need $200,000 of gross income in the previous 2 years with the expectation of having that again in this calendar year. If you file your taxes joint, married, that number is 300,000. The other way you can be accredited is by net worth. And the SEC says if you have $1 million net worth, excluding your primary residence, you're accredited. Now, there's a bunch of other ways to be accredited as well, if you have certain securities licenses, things like that. But that's the two main ways that we're going to be accredited, is either through income or net worth.
So if you've watched my channel for any length of time, you know I traditionally have heartburn with net worth because I think it's a BS made up number. I also have a heartburn around income because I think income is just that thing you brag about. But according to the SEC, those are the two things that are important. Not education, not definition. There's no test. I understand you're operating under the rules that you were given. Totally get it. Totally fine. But those rules suck. There's no education. There's no risk appetite. There's no definitions. Just those two facts alone means nothing to me. And I think it is, I don't know. That doesn't leave me
I'm with you.
fuzzy.
I'm with you on that.
Okay. All right. Well, thank you for allowing me to complain. Again, you operate under the rules defined by you. I always thought it was like, there's not a test. There's not like, hey, do you know what these 10 words mean? I think it is
be
really
based off acumen, right? Just because you make 300 grand doesn't mean you know the first thing about investing in private placement.
No, yeah. Ugh, it's crazy. Anyways, I don't want to get down that rabbit hole. I really want to talk about accredited investors because, again, you've been doing this for a while. The risk-free rate of return, Justin, I don't know if you've heard this, but it's changed. It's gone from roughly 0 to roughly 5, and Jamie Dimon tells us it might go to 7. I'm guessing raising capital in a world where the risk-free rate of return is up 500, it might go up 700 basis points, is a little bit different, but maybe not. What's going on?
Yeah, I mean, I've seen a massive shift in the investor mindset. And it's not necessarily that they don't want to invest. It's the asset classes that they're willing to look at. I mean, I know a ton of people in the real estate space that just can't raise a dollar right now. I mean, even if some of these are good deals where they're assuming 3% long-term debt and they're buying it right. People are terrified of real estate. They're just not going to it, which has been excellent for our fund because we're in the alternative space. Right. So one of the best places I think to park your money right now is in alternative investments that aren't exposed to the markets, that Jay Powell can't ruin it by raising rates. Right. So you have to look at the current climate and say, okay, where is the competitive advantage right now? Right. So why would I invest in the stock market when I can get 4% in the money market? Right. The risk reward isn't there. So, I mean, but people are looking at things like what we do. If we can beat the index significantly without being market correlated in a hedged alternative strategy that's trading currencies and commodities, has nothing to do with the markets. In fact, the more they mess with the money, the more they print, the more they have these currency wars with other countries, the better it is for our strategy. So we're actually having no problem raising capital right now because there's so much money on the sidelines that's looking for the right opportunity.
Yeah, it's really funny because I've been in this game a while. I know some heavy hitters, and it's amazing how many people are sitting on cash right now. Right, a lot of people have been getting prepared for a while, and a lot of them are kind of like, I don't really want to say they're really antsy yet because that's not true. They're patient today. There will be a time in the future where they're vibrating with like, I got to pull the trigger, I got to do something. But they're definitely not there yet. I think they've got to validate inflation is rolled over. I think they got to validate that the Fed is done and they're on pause. I think they're waiting for a few signs to really get excited. But yeah, if they're sitting on cash, maybe it is the alternative stuff they're looking at. Cause I think you're right. Real estate, even with assumptions, probably doesn't, there's so much pain coming and people having to probably lick wounds or raise capital to, to do a cash in refi. Cash in refi is going to become a term for the next year or so. It's pretty wild out there in real estate game.
Yeah, I mean, cash on the sidelines. Like if you want to invest in real estate, I mean, there's going to be distressed sellers. You're going to be able to buy, scoop up these properties at a massive discount. So
Yeah.
I think a lot of people are waiting for that. But what are you going to do in the short term? Like I have an investor, big real estate developer. He uses these hard money loans, and he might raise $30 million at 12%. And then give it to us because we can get him more than 1% a month, right? So while he can't deploy the capital he raised, we're able to provide a return on that. So at least he's breaking even on his debt until he can actually deploy the capital back into real estate. And what I'm seeing with a lot of syndicators is what they're doing instead of something responsible like that. They're like, well, this is LP money. I'm just going to find a deal and get rid of it. And if the investors lose, they lose. So like that's something like if you're looking at investing as an LP, be very, very careful of the way you're sold an investment right now.
I mean, so I've been warning about LPs for at least 18 months now. I have actually I have 2 syndicators on my weekly shows, and we've been talking about all the pain coming. If your GP is pushing to get deals done today, I'm going to wild ass guess that they have very little, if any, real money in the game, and they're just living on fees. That's what's happening now. And that is, I'm not sure if it's criminal, but it is certainly bad karma. And that will eventually catch up with folks. It's sad when this happens.
Yeah. I mean, to make a long-term catastrophic decision for an acquisition fee is just, it's definitely unethical. Is it illegal?
Not for me to define. I'm not a lawyer. That's not where I play, but it's certainly unethical. It's certainly bad karma. And believe me, I know there are syndicators out there who have built teams where they're looking at it. I've got to feed the team. I might as well take this down and get my acquisition fee. I'll buy another 90 days of salaries. No, not okay. Yeah. So, where does this cycle go? Right. So again, we both think that the credit cycle is tightening up. We're seeing liquidity drain. We are seeing deals eventually come. But historically speaking, bad times never last. This too will end. Is it survive to 25? Is it 26? Not sure, but eventually this will come around and we will, be off to the races again. Is that reasonable, or are you one of the types that think we're just going to all fall apart and never come back?
I mean, I think it always comes back because you just don't know how deep and bad the hole is going to be. And I mean, we are living in, every time this happens, it's like it's different than last time. I don't, but it really feels like it is because we're having things happen where like a bank fails and the government backs it. It's like, did we just become a nationalized banking system for the first time? So maybe we are in unprecedented times. Who knows what's going to happen? It's just very strange, just everything that's happening and the lack of discipline across. I mean, think about that, right? If you're going to bail out a bank past the FDIC insured amounts, you're basically telling the banks you can go take more risk.
Exactly. That was a horrible mistake. I believe that was a mistake. Yeah.
Yeah. So, I mean, what does it mean? Like, we have a crash and they just decide to bail out the whole economy and then our currency falls apart. I mean, who knows? It's like, or none of that could happen, right? I think you just have to be prepared, be very strategic. And it's hard not to deploy capital. Trust me, like having cash on the sidelines during an inflationary period where you're losing 5-7% of it every year is tough, but you've got to be prepared to get on an opportunity when it presents itself. And we don't know if it's going to be in 6 months or in 2 years, but have a balance and be prepared.
Yeah. So if somebody wanted to check out, Justin, what you're doing at Kearns Capital, where are we sending them?
Kearns.capital is the website. You can also find me on toptierhuman.com. And then we're all over all the social medias, Justin Freistadt on Instagram, Facebook, YouTube, all that stuff.
Awesome. Thanks, buddy.